The start of 2025 brought disappointing economic news. Retail sales in the United States dropped significantly in January. This marks the sharpest fall since March 2023. The drop signals a potential weakening of consumer spending. This is a worrying sign for the U.S. economy. The decline was widespread across various sectors. This suggests a broader economic trend. Excluding key sectors, sales fell by 0.8%. The decline erased holiday shopping gains. This points to a potential slowdown in consumer demand. The January slump has raised concerns among economists. It serves as a reminder of the fragility of the economic recovery. The decline has prompted discussions about potential weaknesses. Some experts believe it could signal a broader downturn. The significant drop in retail sales is a cause for concern. The data will be crucial in assessing the U.S. economy. It will also shape future economic policies. The decline in retail sales can be attributed to several converging factors. The aftermath of the holiday season is a contributing element. Consumers tend to tighten their belts after a period of increased spending. The holiday season often sees a surge in purchases followed by a natural dip in January. However, the January 2025 decline was more pronounced than usual. This suggests other factors were also at play. Severe winter weather in many parts of the country hampered shopping activity. The cold snap and storms kept shoppers at home, impacting sales. Furthermore, soaring inflation and high heating costs put a strain on household budgets. Consumers were forced to make difficult choices, often cutting back on discretionary spending. The rising cost of essentials like groceries and energy bills left less disposable income for shopping. The confluence of these factors created a perfect storm for retailers. The decline in sales is a clear indication of the challenges facing the U.S. economy. It underscores the need for policies that address inflation and ease the financial burden on consumers. Adding to the economic anxiety was a warning from retail giant Amazon. Despite reporting strong sales and profits in the fourth quarter of 2024, Amazon projected slower growth for the first quarter of 2025. This forecast was significantly lower than analysts' expectations. Amazon's projected growth rate of 5 to 9% for the first quarter would be the slowest in the company's history. This sent shockwaves through the market and fueled concerns about a broader economic slowdown. Amazon's warning was particularly significant given its position as a bellwether for the retail industry. The company's vast reach and customer base make it a reliable indicator of consumer spending patterns. Its cautious forecast suggested that the weakness in retail sales was not an isolated incident. It pointed to a potential softening in consumer demand across the board. Amazon's warning served as a wake-up call for investors and economists alike. It highlighted the growing uncertainty surrounding the economic outlook. The company's projection added weight to concerns about a potential recession. The automotive industry, a key sector in the U.S. economy, also exhibited signs of weakness. After experiencing a rebound in late 2024, auto sales plummeted nearly 3% in January 2025. This sharp reversal raised concerns about the sustainability of the previous growth. Analysts attributed the earlier surge in auto sales to artificial factors. Low interest rates and fears of future tariffs had incentivized consumers to make purchases sooner rather than later. This front-loaded demand created a temporary boost in sales that proved unsustainable. The January decline in auto sales suggested that the underlying demand for vehicles had weakened. This was further corroborated by data from the Federal Reserve, which showed motor vehicle assemblies at their weakest point since July 2024. The slowdown in auto production had ripple effects throughout the industry. Job losses in the auto sector became a growing concern, adding to the economic anxiety. The decline in auto sales and production signaled a potential slowdown in consumer spending and overall economic activity. Mixed signals, industrial production paints an uncertain picture. Data on industrial production presented a mixed picture of the economy. Overall, industrial production rose by 0.5% in January 2025, primarily driven by a surge in utility output due to the cold weather. However, manufacturing output, a crucial indicator of economic health, declined by 0.15%. This back-and-forth movement in industrial production without sustained growth raised concerns about the underlying strength of the economy. The decline in manufacturing output was particularly worrying as it suggested a potential slowdown in business investment and activity. Moreover, motor vehicle output, a significant component of manufacturing, experienced a sharp drop of 5.2%. This decline further highlighted the weakness in the auto sector and its potential drag on the overall economy. The mixed signals from industrial production data added to the uncertainty surrounding the economic outlook. While the increase in overall production offered some encouragement, the decline in manufacturing output raised concerns about a potential slowdown. Cracks in the facade. Labor market weakness emerges. Despite claims of a robust labor market, cracks began to appear in the facade. Job cuts made headlines as companies across various sectors announced layoffs. The technology industry, once a beacon of job creation, witnessed a wave of job cuts as companies adjusted to slowing growth and changing market conditions. Hiring rates also slowed, indicating a potential softening in labor demand. Companies became more cautious about adding to their workforce amid economic uncertainty. The decline in job openings and hiring activity suggested a potential shift in the labor market dynamics. Furthermore, consumer confidence, a crucial driver of economic growth, began to wane. Consumers, faced with rising costs, economic uncertainty, and job insecurity, became more cautious about their spending and financial outlook. The decline in consumer confidence signaled a potential pullback in consumer spending. The emerging weakness in the labor market, coupled with declining consumer confidence, raised concerns about the sustainability of economic growth. It suggested that the underlying fundamentals of the economy might not be as strong as previously believed. Confidence wanes, consumers feeling the pinch. Consumer confidence, a key driver of economic growth, showed signs of waning. The combination of high inflation, rising interest rates, and economic uncertainty weighed heavily on consumers' minds. They became more cautious about their spending habits and less optimistic about the future. Surveys and indices measuring consumer sentiment reflected this growing pessimism. The Conference Board's Consumer Confidence Index, for instance, registered a significant decline, indicating a deterioration in consumers' assessment of current economic conditions and their expectations for the future. This decline in consumer confidence had tangible consequences for the economy. When consumers feel less confident about the future, they tend to cut back on their spending, particularly on discretionary items. This reduction in consumer spending can have a ripple effect throughout the economy, slowing down growth. The waning consumer confidence underscored the fragility of the economic recovery. It highlighted the importance of addressing the root causes of consumer anxiety, such as inflation and economic uncertainty, to restore confidence and support sustainable growth. Trapped in a cycle, the economy that forgot how to grow. The confluence of these economic challenges pointed to a troubling trend. The U.S. economy seemed to be trapped in a cycle of stagnation and false starts. Despite periods of apparent growth, the economy struggled to achieve sustained and robust expansion. This phenomenon, dubbed the forgot how to grow economy, was characterized by cyclical fluctuations without real progress. The economy would experience brief periods of growth, fueled by artificial factors or temporary stimuli, only to fall back into a pattern of stagnation. This cyclical pattern was reminiscent of past economic cycles, where periods of rapid growth were followed by recessions or slowdowns. The underlying causes of this cyclical behavior were complex and multifaceted, ranging from structural issues in the economy to global economic forces. The forgot how to grow economy raised concerns about the long-term health and sustainability of the U.S. economy. It underscored the need for structural reforms and policy changes to address the root causes of this cyclical stagnation and foster sustainable and inclusive growth. A looming shadow is a recession on the horizon. The convergence of negative economic indicators raised a troubling question. Was the U.S. economy heading towards a recession? While a recession was not a foregone conclusion, the warning signs were difficult to ignore. The sharp decline in retail sales, Amazon's cautious forecast, the slowdown in the auto industry, the weakness in the labor market, the decline in consumer confidence, and the cyclical nature of the economy all pointed to a potential economic downturn. Economists and policymakers closely monitored the data, looking for signs of confirmation or contradiction. The coming months would be crucial in determining the trajectory of the U.S. economy. The possibility of a recession loomed as a shadow over the economic outlook, creating uncertainty and anxiety. The question was not if, but when a recession might occur and how severe it might be.